Welcome to the Deep Dive. We're tackling some fundamental questions about stocks today. Lots of people are curious, so let's just jump right in. What exactly is a stock?
Okay, yeah. At its most basic level, a stock really just represents a piece of ownership in a company. When you buy a stock, you're buying a small fraction of that actual business.
So, like owning a tiny slice.
Exactly. The more shares you buy compared to the total number out there, the bigger your slice of that company pie becomes.
Right, okay. And are there different kinds of slices? I hear terms thrown around.
Uh-huh. The two main categories you'll generally run into are common stock and preferred stock. They have some key differences.
Okay, like what?
Well, with common stock, you typically get voting rights. That means you can participate in, electing the board of directors, other major company decisions.
So you get a say.
You get a say, yeah. Preferred stockholders, on the other hand, usually give up those voting rights. But in return, they often get priority for dividends, and those dividends are often fixed amounts.
Fixed payments from the company's profits.
Correct. It's a more predictable income stream, potentially, compared to common stock dividends, which can vary.
And speaking of money, how do stocks actually make money for the owner?
Good question. There are primarily two ways. First is capital gains. That's when the stock's price goes up, and you sell it for more than you originally paid.
Buy low, sell high. The classic idea.
Pretty much. The second way is through dividends, which we just touched on. Some companies choose to distribute a portion of their profits directly back to their shareholders as cash payments. Not all companies do, but many established ones do.
Okay. Now, what about when a company first starts selling stock? That whole IPO thing.
Right, the IPO, initial public offering. That's the moment a private company decides to go public and offer shares to be bought by anyone on a stock exchange for the very first time.
Why do they do that?
Usually the main reason is to raise a significant amount of capital, money to, fuel growth, invest in new projects, pay off debt, or sometimes it allows the original private investors or founders to sell some of their stake. It's a big step for a company.
Makes sense. We also hear market cap mentioned a lot. What does that number tell us?
Market capitalization, or market cap, is essentially the stock market's total valuation of a company. You calculate it pretty simply. Just multiply the current price of one share by the total number of shares the company has issued.
And what does that number signify?
It gives you a quick gauge of the company's size. A large cap stock belongs to a huge company, potentially seen as more stable. Small cap is a smaller company, maybe with more growth potential, but likely more risk, too. It's a basic size indicator.
So what makes the stock prices themselves go up and down? It seems so volatile sometimes.
At the most fundamental level, it really boils down to supply and demand, just like anything else being bought and sold.
More buyers than sellers means the price goes.
Up. Yeah. If demand to buy a stock is higher than the supply of shares people want to sell, buyers have to offer higher prices. Conversely, if more people are trying to sell than buy, the price tends to fall.
And company news, economic reports,
Mm-hmm.
that all feeds into the supply and demand.
Absolutely. Company performance, earnings reports, industry trends, economic news, even just overall investor sentiment, all these things influence whether people feel like buying or selling a particular stock.
Okay, where does this actual buying and selling happen?
That takes place on stock exchanges. Think of them as organized marketplaces like the New York Stock Exchange, NYSE, or the NASDAQ. They provide the platform, the technology, and the rules for buyers and sellers to trade shares efficiently and transparently.
For someone totally new to this, thinking about maybe buying their first stock, how would they even start picking one? It seems overwhelming.
It can feel that way. A common piece of starter advice is to look into companies whose business you already understand, maybe because you use their products or services.
Like a company whose phone or coffee you use every day.
Exactly. If you understand how they make money, it can make the initial research feel a bit less daunting. But, and this is important, that's just a starting point. You absolutely need to do more homework than just recognizing the brand name.
All right, research is key. And we have to mention risk, don't we? It's not guaranteed money.
Definitely not. Investing in stocks always involves risk. Prices fluctuate, companies can underperform, economies can downturn. You could lose some, or even all, of the money you invest. There are absolutely no guarantees.
Good point to emphasize. Lastly, could you quickly explain stock splits? Sometimes you hear about a stock splitting.
Sure, a stock split is when a company increases the number of its outstanding shares, but it simultaneously lowers the price per share proportionally. So if you owned one share at $100, After a 2-for-1 split, you might own 2 shares at $50 each.
So the total value stays the same.
Exactly. The total value of your holding doesn't change just because of the split itself. Companies often do it to make the share price seem lower, perhaps more psychologically appealing or accessible to smaller investors.
And a reverse split is just the opposite.
Correct. A reverse stock split reduces the number of shares and increases the price per share proportionally. Sometimes companies do this if their stock price has fallen very low, maybe to meet exchange listing requirements or just to boost the per share price figure.
Okay, wow. So we've covered quite a bit. Ownership, stock types, returns, IPOs, market cap, price drivers, exchanges, picking stocks, the risks, and splits. That's a solid foundation.
It really covers the core concepts you need to get started.
Definitely. So thinking about all these building blocks, maybe the question for you listening is, which piece of this puzzle feels most intriguing now? Where does your curiosity lead you next in exploring the world of stocks? It's a big landscape, but hopefully this gives you a map to start navigating.